Welcome to today's deep dive into everything you need to know about day trading rules and regulations. Whether you're a beginner trader or you've been doing this for some time, whether you're an international trader or you're a US resident, it's very important that you're familiar with the rules and regulations that govern trading. Because if you make a mistake, you can get your account locked. It can be locked for 90 days, it can even be locked for 12 months. And it could force you to either have to switch brokers or it could put you out of the game completely. So I want to make sure you're all on the same page and you understand the rules and regulations as it pertains to active trading. My name is Ross Cameron. I am a full-time day trader. I funded my first account in 2001, nearly 20 years ago. So I've been around for quite some time. And I have had to deal with a number of the rules and regulations around trading, especially as it pertains to minimum account size, the number of trades you can take in a 5-day rolling period, whether or not you can short a stock. And I've gotten some of those violations on my account that force me to either add more money or have my account locked for 90 days, which is a major pain in the butt. So let's go ahead and dive right in here. I've got my screen share, we've got a slide deck, and we do have quite a lot to cover. So I'm going to begin with one of the simplest explanations, a simple regulation about professional versus non-professional status. Anytime you open a brokerage account, in the forms for opening an account, they will ask you if you're a professional or a non-professional trader. And this throws off a lot of people. And a lot of people will think, wait a second, do I need to have some kind of license in order to trade? What is a professional trader? Okay, so you do not require a license to trade in the stock market as long as you're trading with your own money. However, if you're trading with someone else's money, you are required to get a license. FINRA gives these licenses if you pass the exams, and the license includes, well, there's a number of them, but the most popular, most common ones, I shouldn't say popular, but the most common is a Series 63 or a Series 7. Now, if you wanted to get a job as a trader, let's say you wanted to get a job working at Charles Schwab, and you want to be one of the people when you call up, you talk to a rep. Usually those account reps at Charles Schwab have to have their Series 7 or Series 63 license because that allows them to trade someone else's money. If you call them and you say, hey, can you buy shares of Apple? Well, you can't just talk to just anyone about that. The people that execute those trades for someone else have to be licensed, which means they have to know a certain amount about the market. They have to understand bid and ask, spread, order types, liquidity, volume, all these different things. I mean, it's not incredibly complicated stuff, but it is stuff you need to know. So if you wanted to get a job at a bank, if you wanted to get a job at a hedge fund or anything like that, you most likely would need to get your license. But the employer would typically sponsor you and help you get your license and pay for it. Now, one of the things that's interesting is some traders will hear about prop firms, a proprietary trading desk. A prop firm is a company that has its own money and it hires traders to trade with that money. And the traders get a profit split. But in order to work at a prop firm and get a profit split from the profits you generate, you would have to get your license. Now, these prop firms would sponsor you in getting your license, but you got to pass the exams, you got to study for them and everything else. So it does add a bit of a hurdle. And a lot of these prop firms also make you pay a decent amount of money, basically as an application fee and a training fee and sort of your exam fee. So it's kind of a funny operation. It's not the way I trade. It's not the way I recommend really any beginner trade, because ultimately giving a profit split to the fund, the prop firm, doesn't really make sense for most traders. So if for 99% of you, you're not going to be a professional trader, probably ever. And if you are a professional trader, you certainly already know that because you remember taking your exams. So now the second area that professional versus non-professional status touches is market data. The market data vendors through the exchanges, they have a monopoly on this data. This data, market data, is so carefully protected. And here's why. It's expensive. And the exchanges want to make sure that the firms that are using the data for professional business purposes are paying the big money for it. So if you're a hedge fund, then every hedge fund trader who's getting access to this market data is going to pay way more money than your average Joe Schmo retail trader who's sitting here in their house, trading on E-Trade or whatever it is. So when you declare professional versus non-professional, what you may not realize is something happens behind the scene and it changes how much money you're going to pay for market data. So if you're a non-professional trader, you pay a lot less. If you're a professional trader, the exchanges say, give us more money. Give us that money. So this is something, again, that most of you wouldn't have to worry about, but if you did at one time get your license and you do still have your license, then unfortunately you're kind of stuck with paying the professional data fees. So until your license expires and you're no longer considered a professional trader. So for the rest of you guys, you get the discounted non-professional rate. And in fact, there's a lot of brokers out there like Robinhood, Thinkorswim, that actually don't even charge you market data. They pay for it kind of on your behalf. I'm sure they tuck it in somewhere. I mean, they make enough money, they're able to. Some of the smaller firms can't do that, so they do make you pay for your data, whether it's professional or non-professional, but they make you pay either way. But some of the big firms won't charge you as long as you're non-professional. If you are professional, then they'd make you pay. Now, the next rule that many of you are familiar with is the PDT rule. It's called the PDT rule, the Pattern Day Trader Rule. PDT is an acronym. And the PDT rule was established on February 27th, 2001. This rule states that any trader with a margin account who executes more than 3 trades, so 4 or more trades, within a 5 business day period will be labeled as a pattern day trader. And pattern day traders must maintain a minimum account balance of $25,000. That's a lot of money. But here's, some good news. And this isn't great news, but here's some good news. This rule only applies to US residents. So if you are an international trader, this rule doesn't apply to you, as long as you don't open an account with a US broker-dealer. All US broker-dealers enforce this rule. But if you're a US trader, there are a few ways you can get around it. But you got to make sure you do it the right way, because if you do it the wrong way and you don't understand how this works, you can end up getting your account locked. And that's going to be a major problem. So the pattern day trader rule, it dictates how much you can trade if you have a smaller account. And this is, again, specific to margin accounts. So let's first define what constitutes a day trade. So a day trade is if you do 1 buy and 1 sell, that equals 1 trade. So you buy and then you sell. That's 1 trade if you do that inside of 1 day. If you buy twice and sell once, that's still only 1 trade. It's a round trip. If you buy, and then sell, that's still just 1 trade. But if you buy, sell, then buy back and sell, it's 2 trades. So what constitutes a trade is how many times you change directions. So if you buy, sell, buy, sell, it's still only 2 trades. But if you buy, sell, it's 3 trades. Or if you decide to buy, and then sell, how many trades is that? It's just 1 trade. You could add 10 more sells here, and it's still only 1 trade, because you only change directions once. But when you buy, you sell, you buy, you sell, and then you buy and sell, that would be 3 changes of directions, therefore 3 trades. So if you had a margin account, you could end up using up all of your trades in 1 day, and then you can't trade again until next week, until for 5 days, which is, it basically makes it very hard to trade in your account if you have a margin account and it's under $25,000. So why do we even have this PDT rule? Well, it's about protecting traders and also protecting brokers. The PDT rule, again, only applies to margin accounts. The other type of account is called a cash account, which we'll talk about in a minute. Now, there's a couple of different violations you can get in a cash account, so you got to be careful with that. But the PDT rule only applies to margin accounts in the United States. So US margin accounts allow trading with 4 times leverage. Okay, so you have borrowed money. So by enforcing this PDT rule, they essentially are helping protect, retail traders with less money from potentially getting a margin call. So the way a margin call would work is, let's say you have a $10,000 account and you have 4 times leverage. So you've got $40,000 of buying power. So let's say you buy 10,000 shares of a $4 stock, which would be $40,000. And let's say that stock drops to $2 a share. 10,000 shares, that equals 20,000. So you're down 20 grand on this trade. Wait a second. You only had $10,000 in your account, which means now your account is negative 10,000 and you have a $10,000 margin call. So what happens with this margin call? Well, when you first opened your account and it was a margin account, you would have signed a margin agreement. And that margin agreement would have said that if you lose money, you owe it back to the broker. So if you are in the negative, you now owe the broker that money. So in the short term, you're on the hook. But in the long term, let's say you're broke. You don't have that $10,000. Then the broker is the one who's stuck. And they're going to have to, make up the difference and eat the loss. So to protect the broker, they don't want to have leverage offered to relatively small accounts because there's the risk of blowing up, a big mistake, and then the client owes the money, which the broker may never see. And so they don't want to take that risk. So on February 27, 2001, the PDT rule was enacted. And again, it's only for margin accounts and only because margin accounts have leverage. So in theory, it should protect small account traders from potentially getting a margin call and blowing up their account. Now, prior to May 31st, 2024, we'll talk about a rule that changed on May 31st. But prior to that, so this is foreshadowing, something happened on May 31st. But prior to May 31st, what traders had to do in order to get around the pattern day trader rule, for the most part, was open an account with an international broker. Because the pattern day trader rule is only enforced by US broker dealers. So therefore, if you opened an account with a broker in Ireland or in the Bahamas or really anywhere that's not the United States, you would not be subject to the pattern day trader rule. The only problem is that, unfortunately, or fortunately, a lot of countries won't just let a U.S. resident come and open an account. They'll say, well, wait a second. You got to prove proof of residency. Maybe in Ireland, they only open accounts for residents that are in the EU or that are in Ireland specifically, or the UK, or whatever the case is. So, they have these very specific rules for these, for the brokers. And so what a lot of US traders ended up doing was opening accounts with these small boutique brokers in the Bahamas or in the Caribbean that catered to US residents. I mean, really, they were probably mostly bringing on US residents who wanted to trade and day trade and wanted to have that leverage, but didn't want to have the minimum $25,000. So for years and years, we would open accounts with these international brokers. And many of you may even still have accounts with these brokers because they're still around. So the pros and cons, these international brokers don't enforce the PDT rule. And instead of giving you 4 times leverage, they actually will give you 6 times leverage. So they give you more leverage. Those are pros. But the cons are that these brokers have higher platform fees and commissions. They've got wiring fees. They've got maintenance fees. They don't have deposit insurance. They're not U.S. regulated companies. And they can create tax issues for you because now you've got foreign income. So for me, I funded an account in January of 2017 with one of these offshore brokers. And I funded it with $583 and some change. And by the end of the first week, trading on 6 times leverage, I had doubled the account, $618. By the end of the second week, I made $3,300. By the end of the third week, I made another $4,400. By the end of that first month, I had grown the account from $583 to over $16,000. And there's no way I would have been able to trade that quickly if I was trading in a U.S. account that was under the PDT rule, because I would have been restricted to 3 trades every 5 days. So instead, I was able to take, as many trades as I wanted. And I think I took something like 45 trades that first month. So in theory, I traded like 10 times more than I would have been able to, or something like that, at least 5 times more than I would have been able to had I been trading with a US broker. And I had more leverage. So I traded 49 times. There was 49 trades there, and I maintained 85% accuracy. So this was during that 2017 small account challenge. And then what changed? On May 31st, 2024, the settlement time changed on cash accounts. So it used to be that we had to wait 3 days for a trade to settle. If you took a trade on Monday, You couldn't trade with that money on Tuesday. You couldn't trade with it on Wednesday. You had to wait till Thursday. So, I mean, it was like waiting 3 days for a check to clear. It was ridiculous. And then they changed it to T2. So you only had to wait 2 days. And when it was T2 settlement, what a lot of traders would do is they would fund an account, let's say with, $5,000, for example. And on Monday, they would trade with $2,500. Now, they would buy and sell a stock, $2,500 worth, and then that money wouldn't be available till day 1, day 2, so which is Wednesday. So then on Tuesday, they would trade with $2,500, the other half of the account. And then that money would be available on Thursday. And then on Wednesday, the money from Monday is available. So they trade with that, and then that's available on Friday. So you'd be trading basically half your account balance every other day. And then on May 31st, they changed the settlement time to T1. So now with a T1 settlement, this gets a whole lot easier. You put $5,000 in, and with T1, you could trade $5,000 on Monday, Tuesday, Wednesday, Thursday, and Friday. You could trade that money every single day. So you could trade the full $5,000 on Monday. At the end of the day, you've traded all the money, so you can't take any more trades because you ran out of available cash for buying power. And then the cash resets overnight. So then you could trade again on Tuesday. So the change from T2 to T1 increased the amount that you could trade by double. It doubled the amount that you could trade on any given day in a cash account, which is great. And in fact, it's actually generated more volume in the market because there's a lot of small account traders that were held back and now they can trade more. So we've seen since May more trading volume in the markets, which is generally a good thing. And it's good for the brokers. They want more trading. In fact, the more trading there is, the more money they make on the fees. So now you sort of have a difference in the pros and cons. If you set up a cash account, and just to define what a cash account is, you really have two account types, which I'm going to talk about a little bit more in a second because of the rules and regulations surrounding the two. But just to define them in summary, a cash account is just the money you put in and you're tied to settlement. So you have no leverage here, and you can't borrow money. You can't short stocks. You have to wait for T1 settlement. And then in a margin account, you can trade an infinite amount of times, but you've got the PDT rule, of course. And unfortunately, in a margin account, not only do you have the PDT rule, you have you have a couple of there's a couple other things. We'll get into this more in a second. So now with a cash account, you've got T1 settlement. You've got no commissions, no platform fees if you're using like Robinhood or Thinkorswim. And you've got insured deposits. Yes, you still have to deal with the PDT rule and you've got cash only, but it's a more compelling proposition if you have a small account to just use a cash account. And so I sometimes will ask the question of what's better for a small account trader. Is it better to use a cash account today to start trading, or is it better to use an international broker dealer? So I think for a skilled trader with a track record of success, an international broker dealer will be a tool that you use to maximize returns in a shorter period of time in spite of the fees. But for a beginner trader using real money for the first time, a cash account will force discipline because it's going to force you to focus on quality over quantity because you're limited in how much you can trade every single day. Progress will be slower, but I think it's a more sustainable way to start your career as a beginner. So, as a beginner 5 years ago, that wasn't the case because a cash account only allowed you to trade really a couple times a week. But now with T1 settlement, you really can trade a lot more. So now let's get into these account types in a little bit more detail. All right, so we really have two primary types of accounts, and this is regardless of whether you're a US resident or you're an international trader. If you open an account with Interactive Brokers in Europe or your Webull in Mexico or Canada, wherever, you've got cash accounts and you have margin accounts. So with a cash account, you have no leverage, which means your cash balances, that's the amount of money you can trade with. Whereas with a margin account, you can have up to 4 times leverage. Well, actually, it's up to 6 times leverage if you use some of these international brokers. So, in most cases, it's 4 times leverage. Even in brokers that are international, it's only a couple that offer 6 times. But there should be actually an asterisk here because some brokers will require higher minimum account sizes in order to trade on leverage. Trade Zero is a broker in the Bahamas that accepts international traders. They require, I think, $500 minimum account size. I think it might be $2,500 to have 6 times leverage. Interactive Brokers, I think, requires $2,500 for leverage as well, but they only offer 4 times leverage. A margin account, you don't have to wait for settlement. So you can trade as much as you want. You do have margin, which means you can short stocks if you want to. And there are no limits on day trading, asterisks, except for the PDT rule. The PDT rule is really your only limit. And that is a significant limiting factor. That's definitely a rule that's going to hold back a lot of traders. Now, you also have in the United States and in other countries as well, cash accounts and margin accounts that are designated specifically as retirement accounts. So a retirement account is a tax-deferred or potentially tax-free account, depending on how you set it up and what country you live in. So here in the United States, we have IRAs, which are individual retirement accounts. I know in Japan, you've got the NISA accounts. So a lot of different countries offer these different types of retirement incentives. The government wants you to save for retirement. The more you save for retirement, the less you'll have to depend on social services and things like that. So you're able to set up these accounts, which are tax-free. Now, the Roth IRA in the United States is one of the most popular retirement accounts because the growth is tax-free and the distributions are tax-free. So with a cash account, retirement account, a cash Roth IRA, for instance, you have no leverage because it's a cash account. You still have to wait on T1 settlement. You have no margin, and there's no limits on day trading, but of course you'll run out of money when you run out of cash. And so most traders who are under $25,000 in the United States will set up a Roth IRA as a cash account. Once you're over 25,000, you could change that account from a cash account to a margin account. And at that point, you can trade as much as you want. But even in a Roth IRA margin account, you still have the PDT rule. So a Roth IRA account that's margin, that's under 25K, you're going to be back to the same restrictions as a margin account. It's going to be a pain in the butt. You're not going to be able to trade as much as you want. So when you go to open an account, opening an account, whether it's a cash account or a margin account or a retirement account, it's very similar to opening a bank account. You'll have to generally provide identification and proof of residency with a mailing address. So you usually have to provide like a utility bill or something like that to prove your physical address. This is true in the United States for all brokers as part of their, they have this bank compliance stuff where they've, after September 11th, they had all these new rules that came into effect with banking. And then of course they amplified during the Great Recession and the banking crisis of 2007, 2008. So now there's a lot of restrictions on who can open accounts and what country you can be in and this and that. And it's true that, there's a lot of US brokers that are happy to accept international traders. So the broker that I use, which is called Lightspeed Trading, they accept international traders. But if you're an international trader, you're then going to subject yourself to the pattern day trader rule, because even though you're international as a US broker dealer, they're still required to enforce this $25,000 minimum on you. So most international traders aren't going to use a US broker. They'll use maybe Webull, depending on what country they're in. They'll use Interactive Brokers or maybe Trade Zero, CMEG, one of these international brokers that don't enforce the PDT rule. So now, once you've got your account open, you've got to be aware of certain account violations. And I've seen this happen for a number of beginner traders, and it can be super frustrating. The first is called a free riding violation. So a free riding violation occurs if you deposit money into your trading account, you trade with that money before the funds have settled, and some brokers will let you do this on good faith, essentially, and then the funds don't settle. All right. So now you traded with money that was actually never there, and you will have a free riding violation. The rules on free riding violations are strict. If this happens just once during a 12-month period, a client could be restricted to using settled cash only for 90 days. and profits from the trade could be seized, and any losses incurred by the trade would be the client's responsibility if they're forced to liquidate the position at a loss because your check didn't clear for funding the account. So it's always, hopefully this wouldn't happen as long as you're not writing a bad check, but it has happened before to people just by mistake, and so it's something to be aware of. Now, a good faith violation, this one's a little bit different. So if you sell a position in a cash account and then you buy a new position and sell it before the original trade cleared, your account can get restricted to trading with settled cash only for 90 days. And this actually just happened to me recently during my small account challenge. So what happened was I had my small account challenge and I had a cash account set up. And what I didn't realize was that Thinkorswim and Charles Schwab don't automatically restrict you to only trading the amount of cash you have. So what I thought was, oh, I funded the account and whatever. Let's just say at one point I had $15,000 in it. So I just figured, all right, if I take $15,000 worth of trades, my available buying power, each trade I take will go lower and lower and lower until eventually it's zero, and my order will get rejected. But in fact, that's not true. You take a trade, you sell the trade, and they add the money back into your account. And it's your responsibility not to day trade with that money again. And if you do, your account gets restricted. And so my account got actually restricted for 90 days. However, the restriction was that I could only trade with settled cash, which is actually what I kind of wanted in the first place. So the restriction for me wasn't a big deal, but a restriction that can be a big deal for people is if you get in trouble for violating the PDT rule. So if you have an account that is a margin account and it's under $25,000 and you take more than the 4 trades, you take 4 or more trades within that 5-day period, then you'll be issued a margin call. So let's say your account has, well, first of all, let's say you have $27,500 in your account and you've been day trading the account for months and months and months. So you're already flagged as a pattern day trader. Now, the problem here is that since you've been flagged as a pattern day trader, they're going to say, let's say you take a loss and your account goes down to $24,950. They're going to say you need to add $50 to your account to get it back up to $25,000 because you've already been flagged as a pattern day trader. So you're going to get a margin call of $50. And unfortunately, until you add that money, you cannot trade in your account at all, which is obviously a drag. And this is exactly what used to happen to me. I would have my account right above 25,000, then I would take a loss. I'd have to add more money into the account. My account would be restricted. Then eventually I'd get it back up. Now, the other scenario where you can get a margin call is, let's say you have like an $18,000 account. It doesn't matter. It's just any amount under 25K, but it's still a margin account. So it could be 8,000, doesn't matter. And you take 4 trades. Well, when you take that 4th trade, now the nice thing, by the way, with Charles Schwab is they'll actually tell you, they'll say, wait a second, if you take this next trade, if you buy a stock right now, you cannot sell it today or you're going to trigger the 4th day trade within a 5-day period. So they warn you, which is nice, but not all brokers do warn you. So if they don't warn you and you go ahead and take that 4th trade, then your account is locked. They'll say you have to put in $16,000 to get your account to 25 grand. And you'll be thinking, impossible. I can't do that. So what do I do? At this point, you've got a couple choices. Choice number 1 is you close your account and you switch to a different broker. And the different broker you'll be a net new account and you won't have that. That violation doesn't carry from broker to broker. So you could do that. And I did that in the past when I was a beginner trader. What you can also do is you can call the broker and say, you got to beg. You got to say, I'm so sorry. This was a mistake. I don't know what I was thinking. I had a bad day and it was an awful morning and I had terrible diarrhea. I don't know what I was thinking. And they'll say, I've heard enough. I've heard enough. I'll press the reset button. That's all I have to do. All you have to do is convince them to press the reset button. They press that reset button and you're good. But they'll only do that for you a couple times. So you got to make sure you think about your excuses very carefully because they'll only give you that reset a couple times. You've got to be really careful. Okay, so that's an option, and many people will do it, but you'll learn quickly that you can only use that so many times before it stops working. So those are 3 very specific account violations that you have to be aware of. Now, something else you've got to know about when it comes to day trading, and this is especially in the United States, is wash sales. Wash sales are a tax implication. So a wash sale occurs when you sell a position for a loss and then you buy it back a what's called, quote, substantially similar position within 30 days. When you do this, you're not allowed to write off the initial loss. So now let's think about this for a second. So let's say you took a trade on, whatever, it was May 1st, and you took a trade and you lost $3,000. All right, so now you've got a $3,000 loss that you'll be able to apply against any profit that you have. But then on May 10th, you buy back the same stock and you make, let's just say, $1,000. So now you've got $1,000 of profit. Well, because you bought back the stock, you now can't write off the initial loss. So now you're in a situation where you show $1,000 of gain, even though in net, you're actually down $2,000 still. This is a problem. And so when you get your 1099 from your broker, all US residents get 1099s from the broker, they will have, your net profit loss, and then they'll say wash sales exempt. And they'll have an amount of money where these were the wash sales that you had, where you had the loss and you bought back a position, so you can't write off more than this amount. And so what it effectively does is it increases your net profit on the year. Now, I've heard of traders who trade the same stock every day, like something like Apple or Netflix and Amazon, doesn't matter. They trade the same stock every single day. And then at the end of the year, they're like, whoa, wait a second. It's showing that I made a lot more money than I actually made because it's taking away my losses, right? I mean, if you made 100,000, but you lost 90,000 and you're only up net 10 grand, of course, it shouldn't show that you're up $100,000 and you have to pay $50,000 in income tax. That doesn't make any sense. And obviously, if you hire a good accountant and a CPA, they can help resolve that for you, because this wash sale rule was actually designed because what investors used to do is if they were holding a losing position, a position that they were red on, let's say December 20th, they would sell the position for a loss. So their 1099 at the end of the year would show a loss, and then they would buy back the position on January 1st. Now, that's why they don't issue 1099s until February, because they got to make sure you didn't buy back a December loss in January to try to book the loss. It's tax loss harvesting is a more modern phrase, but you still can't buy back the position if you're going to take that loss. So because so many people were doing that for so long, the IRS came up with this wash sale rule. So then how do active traders like myself avoid wash sales? There's really 2 ways you can avoid them. The first is mark-to-market accounting. Mark-to-market accounting mark-to-market accounting is a change in accounting status that you file with the IRS via Form 3115, not to get into the weeds, but it's an option for full-time traders, and you have to notify your broker after the IRS accepts this election. And from this point forward, you're exempt from wash sales. So you can do mark-to-market accounting, and then you're exempt from wash sales. The only problem is it doesn't work retroactively. It only works from this day forward. And in fact, it's actually for the tax year. So in order for the current tax year, so you've got current tax year right here. In order to have mark-to-market accounting for this year, you actually have to file your Form 3115 by April 15th. So you've actually got to get it by April 15th for it to apply for this tax year. So if you get it on, November 5th or whatever it is, doesn't matter. Unfortunately, it won't apply until January 1 of the following year, Jan 1. whatever. So that's a little bit of a nuance there. And anyways, once you get the mark-to-market election accepted by the IRS, you do have to notify your broker, and they change on their back end your tax status. So you'll no longer have any wash sales. So that's something that I did, and many traders will do. Alternatively, for what it's worth, trading in a retirement account will exempt you from wash sales as well, because the account is tax protected. There's already no tax on it. So this is also a good option for you if you'd be interested. I mean, it depends on your individual situation, because if you're trying to generate profit from the market to cover cost of living, then of course you need to be able to take the profit out. So you'll have to trade in a taxable account. So either mark-to-market election via Form 3115, or I think it's Section 429 of the IRS code, where you can read more about it, or you trade in a Roth IRA or an individual IRA. Now, the next rule and regulation we're going to talk about is the short sale restriction. So first of all, in order to short a stock, if you want to short a stock, you must trade in a margin account. So you have to have a margin account. That's a rule in order to short. This is a requirement. And the reason is because when you short, you're borrowing a position from someone else to create that negative short position. And that means you've borrowed something. So you have to have the margin agreement on file, which means you promise to pay back if you lose. If you, in a cash account, you don't have a margin agreement because the most you can lose is your own money. But in a margin account, because you can trade with leverage and you can short stocks, which means you're borrowing a stock from someone else to sell it in the market, you have to have the margin agreement, which states that you'll repay any losses you have. So number one, to short, you need to have a margin account. And number two, you'll find that many stocks will have SSR enabled, which is the short sale restriction. So if a stock has a short sale restriction, you can only short it on an uptick. The short sale restriction is a rule that was created a long time ago to prevent bear raids or flash crashes, where the price of a stock is driven down by short sellers, which is, not good for the stock market. The stock market's designed for creation of wealth and for stocks to go up, not for them to get pummeled into the ground. So regulators created this short sale restriction. If a stock drops 10% from the previous day's close, the short sale restriction is activated for the rest of the day. And in that case, the only way to short the stock will be on an uptick. So I'll give you an example of what this looks like. So this is a stock, for instance, that has the short sale restriction on. So if I press the sell button right now to go short and to sell to this person buying at $6.91, my order would it wouldn't execute. It would just sit there. I would not be able to get filled until someone buys shares from me. So let me switch to my other account. This is a retirement account, but I'll switch to my margin account. So this account is a taxable account, which means I can short stocks. So Bank of America, and I'll just drag this whole thing up so you can see it better. All right, I'm going to move this up here so we could look at the whole account. All right, so Bank of America right here, let's say I want to short one share of it, and I want to short at 45.12. I put the sell button out. That's in order to sell one share at 45.12. Now, this stock is not on short sale restriction, which means if I want to short it right now, I can short at 45.10. Boom, just like that, I'm short one share of the stock because this is not on short sale restriction. So there's no issue with shorting it. Now, unfortunately, so this stock, I'll explain that in a second. So with a short sale restriction, you cannot short on the bid. You can only short by having your order sit on the ask. So now I'm going to buy back this one share I shorted. And I'm going to show you, this is how you short if you have a stock with short sale restriction. You have to put your order here on the offer and wait for someone to come buy the shares that you're selling. So the effect that this has is you can't clear out all the people here that are buying by just selling and selling and selling to them. You can only sell when someone comes and buys your shares. So in a very weak market, when there's not a lot of buyers, it's actually going to be harder to short a stock because of this short sale restriction regulation. And in fact, there's a number of reasons why shorting is more difficult than trading to the long side. The first is because of the short sale restriction. The second is because a lot of brokers will restrict your ability to even borrow shares in the first place. They don't want you to borrow shares because they're afraid that you're going to blow up your account and you're going to owe the broker money, just like the reason that they created the PDT rule in the first place. And so what a lot of brokers will do is they'll simply say, you know what, no, you cannot short this penny stock. This stock is 15 cents a share, which means if you short it, the most you can make is if it goes to zero. What if it goes to $10 a share? You're going to lose $1 million. No way. You're not shorting the stock. So now all penny stocks, for the most part, are hard to borrow or hard to short. So even if you have a great idea, because of the restrictions around short selling, it's going to be harder to short the stock. So number one, short sale restriction. Number two, availability of shares to borrow. Number three, borrowing fees. So borrowing fees are the fees you have to pay your broker to borrow shares of a stock that is difficult to borrow. And you're going to pay those fees every single day that you're holding a stock short that has a borrowing fee. And so you end up spending sometimes more money in borrowing fees than you could even make in profit, which of course doesn't make sense. So as a result, short selling is going to be more difficult. Now, this stock has a T, which means it's on the threshold list. A stock that's on the threshold list, if you go down here to try to borrow shares, it's going to say not eligible. No one is allowed to short a stock that is on the threshold list. So some companies end up going on the threshold list because of failures to deliver, which is sometimes tied to naked short selling. And when that happens, nobody can short the stock, even if you want to. So there are some elaborate equity swaps that institutional traders will do to effectively create a synthetic short position, even though they're not actually shorting the stock. That's not something that any retail trader like you or I would be able to do. So it's almost not even worth mentioning. But anyways, so there are a number of restrictions that govern short selling and will make it more difficult. Now, the next rule that I want to talk about pertains to circuit breaker halts. There's a lot of misinformation about circuit breaker halts. So I would say circuit breaker halts are actually our favorite types of halts as day traders. The exchanges, plural, NASDAQ, the New York Stock Exchange, American Stock Exchange, they can halt trading of stocks on their exchange at any time if they feel it's appropriate. Why would they halt trading in shares? They can halt trading in shares if they are going to conduct an investigation into the company. If they're worried about fraud or something like that, they'll halt the shares while they do their investigation. If the company asks the exchange to halt shares trading in their stock, then the exchange will do it on the request of the company. Usually a company will do this and it'll say halted pending news. And it means the company is going to put out some news. And they don't want anyone to trade the stock while the news comes out until the news has been released, it's been read by everyone can think about it, and then trading can begin. Usually that happens when bad news comes out. They want to give people like a moment to not be able to trade the stock so they can't panic sell. Although sometimes when it begins trading, they still panic sell. And then the other type of halt is a circuit breaker halt. It's also called a limit up, limit down halt. So limit up, limit down. Limit up, limit down, LULD. So this halt occurs all the time. We see this all the time. And this is not something that concerns me, but during the GameStop era, a lot of people were saying the exchanges, they're suspending trading, they're cheating the system, they're trying to, this and that. When it's actually just a mechanism, like if you overload a circuit at your house and you flip the circuit breaker. It's a mechanism that's completely automated that the exchange has really no active control over. It's just a rule that was created. So the way this works is circuit breaker halts will occur if a stock moves more than a certain amount within a certain period of time. So a tier 1 security with the previous close above $3 a share will halt if it goes up more than 5% within a 5-minute period. And a tier 1 security is like an S&P 500 company. Tier 2 securities are all the other stocks in the market. And tier 2 securities priced above $3 will halt if they go up more than 10% within a period of about 5 minutes. Now, what's interesting is that these circuit breaker halts only occur from 9:30 a.m. until 4 p.m. So pre-market from 4 a.m. until 9:30, and after hours from 4 p.m. till 8 p.m., there are no circuit breaker halts. So a stock could go up 900%, 1,000% without getting halted. And we've seen it, and I've traded it, and I've made a lot of money on them. But during regular trading hours, if a stock goes up, again, a stock that fits into this category, above $3, tier 2 security, if it goes up more than 10% in a 5-minute period, it'll be halted for a period of 5 minutes. Now, what's kind of interesting about these halts is that if it goes up 10%, so up 10% in 5 minutes from reference price. So what's the reference price? The reference price is the average price over 5 minutes. So this gets a little bit confusing because let's say, for instance, a stock goes from, this will be $3, goes from 3 to 350 to 4 to 450 to 5. So it actually went up from $3 to $5 over the course of 5 candles. So in this scenario, it went up $2 a share. Now, let's say it was going sideways for 5 minutes before it went up. So then its average price over the last 5 minutes is resetting approximately every 30 seconds. And it's, what is the average price over the last 5 minutes? Updating every 30 seconds. So now the average price over these last 5 candles is going to be like here. The average price over these last 5 candles is going to be like here. So the average price is actually continually moving up. And then the halt band is exactly 10% above that level, depending again on the category that the stock falls within. So stocks that were priced between 75 cents and $3 based on the previous day's close will halt every 20%. Stocks priced below 75 cents will halt either every 75% or every 15 cents. And in practice, it happens every 15 cents. And so what's kind of interesting here, as an example, is you could have a stock that closed yesterday at 74 cents. So that means it's going to halt every 15 cents. And let's say today, right now, it has squeezed all the way up to $3.25 a share. What's the halt band? Plus 15 cents, approximately $3.40. The halt bands are going to be very tight on this stock. And you could have a stock that, on the flip side, yesterday closed at, let's say, $2.99. And therefore, the halt bands are what? Every 20%. So that's going to halt at $3.60. Holy smokes. Or you have a stock that closed at 301 and the halts are going to be at every 10%, and therefore it's going to halt at 330 approximately. So it's very interesting. And this is why a lot of traders during the GameStop era were like, wow, that the exchanges are doing something shady. They're halting these stocks willy-nilly. But in fact, there are a set of guidelines that dictate how these work. They're just not very straightforward for most people to understand. And let's throw another wrench in it. From 3:35 to 4 p.m., all of these bands are doubled in size. So they go to 30 cents to 40% and to 20%. And it used to be that from 9:30 to 9:45, the bands were also doubled. And then they took that away. So they did change that rule at one point. So, and they may change this rule as well. And with the markets moving to, a 22-hour, 24-hour a day market, it's possible that we'll see even more changes. So all of that is subject to change. But these things change very slowly when it comes to the rules and regulations in the market. I mean, the PDT rule has been around for over 20 years. The short sale restriction rule has been around for forever. The threshold rule with Reg NMS and NBBO, these have been around for a long time. So, these rules get enacted and the market is very complex because what ends up happening is, there at some point a rule gets enacted. And then as a result of that rule, market behavior changes a little bit. So then they create a new rule to address these changes in market behavior. So then that's layered on top of the first rule. And then they realize even more things change, and then they've got to add another rule onto this. So it's a lot of patchwork. And sometimes it's like, well, if you just gone back and looked at this first rule in the beginning, maybe that should have gotten changed. But like old rules don't often change, but new rules get kind of layered in. And so the plumbing of the market and the rules that dictate how it all works can be fairly confusing, especially for a beginner trader. Now, some rules, however, are more straightforward, and we'll talk about some of those in a moment. Now, when it comes to the halt levels, when you're looking at a stock, I can see LULD on my level 2 window. This is level 2 data right here, and it shows me the limit up and the limit down. So that's the limit down, that's the limit up. And in this case, it's going to be 10% above the current price, approximately, 10% above the average price. This is a stock here where the halt also is 10% above and below the current price. Both of these stocks must have closed the previous day above $3 a share. This stock's easy to borrow. This stock is harder to borrow. Neither stock is on short sale restriction. So a lot of broker dealers, however, do not show you the limit up, limit down levels, including Thinkorswim. So if you're with one of those brokers, you don't actually know what that level is without doing the manual calculation, which is kind of a pain in the butt. The simulator that a lot of our members at Warrior Trading use, that we offer for them as part of their Warrior Pro membership, does include limit up, limit down levels. So you can see that on the level 2. And that's good because I do think it's important to understand how it works. When a stock is halted, you cannot trade. You'll see the H for halt code, which means the stock is halted. And you can see the quotes, which is showing you the current auction, which will tell you approximately where the stock will resume trading when it resumes. All circuit breaker halts take place for a minimum of a 5-minute pause. The stock is halted for 5 minutes, and then after 5 minutes, it will resume trading unless the resumption price is actually higher than the reference point of the average price going into the halt, in which case the stock will be halted basically immediately for another 5 minutes. And it can stay halted for 10 minutes, 15 minutes, 20 minutes. Sometimes we'll see a stock where, for instance, it halts up at, $6, and then it's showing a resumption of 7. Now that's more than 10% above 6. So all of a sudden here, and again, this would be assuming the stock closed above $3 on the previous day. So now it's showing 7, so it's going to be halted most likely for 10 minutes. So, but if it was showing, let's say like a $15 resumption, it could potentially be halted for 30 minutes or more. It's not uncommon to see that. But the length of the resumption is something where there does seem to be an ability for institutional traders to a certain extent control how long a stock is halted by adjusting their bids and offers during the halt, which changes the resumption price. So again, that gets a little complicated, but you can see the resumption price on your level 2. Well, again, depending on who you use. The simulator that we offer does show resumption prices, so you'll be able to see that. Now, a more clear-cut a rule or regulation in the market is called order spoofing. Order spoofing is the practice of placing orders with no intention of those orders being filled. So the problem here is, and there's a typo I see. So the problem here with these orders is the only intention is that the order will influence the way other traders think about support or resistance on a stock. So I'll give you an example of what that would look like. So without actually doing an order spoof myself, I'll just show you essentially what it is. So let's say that Bank of America 4509 this is the price. And let's just say that you really don't want to see the stock break that price. What if you put out an order to buy 100,000 shares and you throw that order at $45 on the bid or 45.01? Now, by making that order visible, you would be tipping your hand to the entire market that I really like this stock and I think it's going to hold this level. But if you place that order with the pure intention of getting other people to think someone likes this stock, but if it actually came down to 45, you would cancel your order immediately so it doesn't get filled and you don't buy 100,000 shares, then that's called order spoofing. So order spoofing is a manipulative practice. Now, it's something that you've probably heard about hedge funds doing, and they sometimes brag about doing it. It's something that has happened. We've seen investment banks that have gotten in trouble for it, that have been doing it in the commodities markets and currency markets. So it does happen in the market, but brokers are required as part of their compliance programs to basically to search for that type of behavior. So they have probably algorithms that look for that type of behavior. And if they catch their clients doing it, they'll just close their account. So that they're kind of, FINRA is the regulatory body, but they tell the brokers, hey, you got to make sure people in your firm aren't breaking the rules. So now the broker becomes liable to make sure they don't have a bunch of traders in their, under their umbrella that are engaging in this behavior. So if you were doing order spoofing, you could get a letter from your broker and they're saying, they could ask you a question, I suppose, like, why are you doing this? Or they could just shut down your account completely. They say, we don't want you and we're going to blacklist you. And I don't know if they share those names with other brokers. I'm not sure how that works, but obviously it goes without saying that's not something you should do. Now, most traders with relatively small accounts wouldn't really even be able to do order spoofing, even if they wanted to, because you don't have the ability to buy 100,000 shares of a stock at $45 a share. I don't even leave that kind of money in my account. I mean, those are $1 million orders. So realistically, the people that are doing that kind of spoofing most likely are institutional traders. They may even be professional traders or licensed traders who just simply don't care or think that they'll get away with it and the bank will cover their butt. These are people who work under a big bank and the bank says, make the money and we'll figure out the rest. And you've probably heard that if you watched the Wall Street documentary or the HBO documentary called Gaming Wall Street. So unfortunately, it does happen in the market. However, I have noticed that it happens more on stocks that are more popular among institutional traders than on small cap stocks. So you're more likely to actually see it on big name companies than small companies. And I suppose another rule to be aware of would be insider trading. I mean, this is kind of goes without saying, but insider trading obviously is against the rules. Insider trading is when you're trading on information that you receive that's non-public. So realistically, 99% of you guys watching this, including me, don't know anyone who's a CEO of a publicly traded company who could go and whisper to you at a party in the Hamptons, hey, my stock's going to do really great next quarter, hint, hint. But in some of those affluent circles, people do get that kind of information. And maybe they don't get it with the intention of, maybe they're just at a cocktail party and someone works or is a CEO at a company and says something. But now, if you know that information, you actually have an obligation not to tell other people what you know, and not to act on it, not to trade on it. Because if you trade on it, then any money you make was at an unfair advantage, and that's called insider trading, and that is against the law. So there are a number of rules and regulations in the market, and certainly order spoofing and insider trading would be very black and white. But the violations around the PDT rule and, all of the different, the good faith violation, the free riding violation, these 90-day violations, these are significant, and these can have a real impact for a beginner trader who's trying to get themselves started and then all of a sudden is hit with, boom, I'm locked out of my account. So if you guys enjoyed this episode, I sure hope you hit that thumbs up, you subscribe to this channel, and if you want to learn more about the strategy that I trade every single day, I'll put a link, I'll pin to the top of the comments, and I'll put it in the description where you can get started. I have a free day trading course that you guys could watch, or you could do a 2-week trial at Warrior Trading, and you can use the software that I'm using every single day and see what it's like. So I want to thank you guys as always for joining. I'll remind you, trading is risky and my results aren't typical. So manage your risk and always practice in a simulator before you put real money on the line. I'll see you for the next episode real soon.